Let's start with something uncomfortable. Right now, somewhere on cable news, a very serious person in a very expensive suit is yelling about government spending. They're pointing at a giant red number on a screen. Trillions, with a T, and they're telling you the same story you've heard 100 times before. We're broke. America is drowning in debt. This will bankrupt our children. Cue dramatic music. Roll footage of the Capitol. Cut to a stock photo of worried families. And if you're watching this as an American adult, especially between 25 and 60, your brain probably does this quiet little thing. Yeah, that sounds bad. But also, hasn't this been bad forever? Exactly. Here's the first psychological trick I want you to notice. If something is truly an emergency, but it lasts for decades without exploding, your brain stops treating it like an emergency. It becomes background noise, like traffic, or student loans, or that weird noise your car makes that you've decided to ignore because fixing it feels emotionally expensive. The U.S. national debt is that noise. $36 trillion, and counting. That number is so big it has crossed into science fiction territory. Your brain can't picture it. You don't feel it. So instead of understanding it, most people react emotionally. Some panic, some shrug, some turn it into politics. Almost nobody actually understands how it works. And that's not an accident, because if Americans truly understood what national debt is, and what it isn't, a lot of fear-based narratives would instantly collapse, and a lot of very powerful people would lose their favorite talking points. So let's do something radical. Let's slow down, let's think clearly, and let's talk about government debt like adults. Not like characters screaming at each other in a cartoon. Well, actually, more like smart cartoon characters. Because yes, this video looks like Futurama and The Simpsons. But the economics behind it? Very real. Very American. And very relevant to your money, your investments, and your future. Now here's the hook. Lean in. What if I told you that almost every country on Earth is in debt, including the richest, most stable, most powerful nations? Not just struggling countries, not just corrupt governments, Germany, Japan, Switzerland, the United States. Even countries you think of as financially responsible are deeply in debt. Japan's government debt is more than 200% of its entire economy. The United States? About $36 trillion, roughly 120% of GDP. And yet, Japan hasn't collapsed. The US hasn't collapsed. People still get paid. Markets still function. Life goes on. So either the world's top economists are all insane, or the story you've been told about debt is missing something important. Here's where most people get confused. They hear the word debt and immediately map it onto their personal life. Credit cards, mortgages, student loans. And that mental shortcut feels logical, but it's wrong. Because a government is not a household. If you spend more than you earn, eventually the bank cuts you off. If a government spends more than it earns, something very different happens. Before we go any further, we need to clean up one massive misunderstanding. When people say America is in debt, they usually imagine one giant credit card bill. That's not how this works. The U.S. national debt refers only to what the federal government owes. Not states like California or Texas. Not cities. Not your mortgage. Not your credit cards. Not your student loans. Federal debt is its own thing. And even within that, it splits into two very different categories. First, debt held by the public. This is money borrowed from investors, individuals, banks, pension funds, mutual funds, foreign governments. When you buy U.S. Treasury bonds, you are literally lending money to the U.S. government. The government promises to pay you back with interest. Boring? Yes. Safe? Historically very. Second, intragovernmental debt. This sounds scary, but it's actually kind of hilarious. This is when one part of the government owes money to another part of the government. For example, Social Security runs surpluses in good years. Those extra funds don't sit in a vault like Scrooge McDuck's money bin. They're invested in U.S. Treasury bonds. So technically, the government owes money to itself. About 1/5 of U.S. debt falls into this category. So when headlines scream, "America owes trillions," a chunk of that is basically the government saying, "I owe myself money, and I promise I'll pay myself back." Not exactly the apocalypse. Now here's the next big question. And this is where people really start yelling. If the government controls the currency, why doesn't it just print more money? Ah, yes, the magical money printer argument. If you've ever said, "Why don't they just print it?" Congratulations. You've independently rediscovered the idea that has destroyed multiple economies. Printing money to cover spending sounds harmless, until it isn't. When governments create money without corresponding economic growth, you don't get prosperity. You get inflation, sometimes hyperinflation. Your dollars buy less, prices rise, savings evaporate. This isn't theoretical. Venezuela, Zimbabwe, Weimar Germany, all examples of governments that treated money like monopoly cash. And once people lose trust in a currency, that trust is almost impossible to rebuild. That's why borrowing exists. Debt creates discipline. When the U.S. government borrows money, it agrees to pay interest. That forces at least some level of accountability. Investors are watching, credit rating agencies are watching, markets are watching. Debt isn't free money. It's a contract. Now let's get to the real reason governments borrow. Spoiler, it's not because they're stupid. The most common reason is simple math. Governments collect money through taxes. Sometimes, expenses exceed revenue. That gap is called a budget deficit. If the government brings in $3 trillion but needs $4 trillion to fund defense, healthcare, infrastructure, and everything else, it has three options. Option 1, slash spending, cut programs, cut services, cut benefits. Politically, painful. Socially, explosive. Option 2, raise taxes. On who? The middle class, businesses, the wealthy. Also politically explosive. Option 3, borrow. Borrowing is the least immediately painful option, which is why it's used so often. And that's before we even talk about long-term investment. Debt isn't automatically bad. If you borrow to buy something that generates future value, that debt can be productive. Infrastructure, education, healthcare systems. If borrowing $1 today helps grow the economy by $3 tomorrow, that's not reckless. That's leverage. The U.S. interstate highway system was built with debt. Public universities expanded with debt. Major research breakthroughs were funded with debt. Those investments paid off. Massively. The problem isn't debt itself. The problem is what the debt is used for. Now add crises into the mix. Wars, financial collapses, pandemics. In 2020, the U.S. government spent trillions responding to COVID-19. Stimulus checks, business support, healthcare funding. Was that debt-free? No, but without it, the economic damage would likely have been far worse. Sometimes borrowing isn't optional, it's survival. And then there's the most awkward reason governments borrow: to pay off old debt. Yes, governments refinance debt the same way homeowners refinance mortgages. Old bonds mature, new bonds are issued to pay them off. As long as investors believe the government can meet its obligations, the cycle continues. This works until it doesn't. When confidence collapses, debt spirals turn ugly. Just ask Sri Lanka, or Argentina, or Greece. Which brings us to the question nobody likes to answer honestly. Is national debt good or bad? The most accurate answer is, it depends. Debt used wisely can stabilize economies and fuel growth. Debt abused can strangle a country under interest payments. The difference isn't the number. It's trust. Trust that the economy can grow. Trust that the government can collect taxes. Trust that institutions still function. Once trust disappears, debt becomes toxic. And this is where Americans need to think carefully. Because the U.S. is in a unique position. It issues the world's reserve currency. Its debt is considered one of the safest assets on Earth. Global markets depend on U.S. treasuries. That doesn't make America invincible. But it does mean the rules are different. And if you're an investor, a saver, or just someone trying to make sense of money in this system, you need to understand those rules, not the simplified fear version sold on TV. Because here's the uncomfortable truth. National debt isn't just a government issue. It's a mirror. It reflects how society thinks about growth, responsibility, risk, and the future. And if you don't understand the system, you can't protect yourself inside it. Which leads us to the next question. And this is where things get really interesting. If governments borrow all this money? So let's answer the question that quietly terrifies people once they actually think about it. If the US government owes tens of trillions of dollars, who exactly is sitting there, arms crossed, waiting to be paid? Is it China? Is it shadowy bankers in a smoke-filled room? Is it some evil villain stroking a white cat while whispering, "Soon America will pay"? Relax. The reality is way less cinematic and way more interesting. First, the most uncomfortable truth for Americans to hear. A huge portion of US debt is owed to Americans. Yes, you. If you own a pension fund, a retirement account, a bond ETF, or even certain insurance products, congratulations. You are a creditor of the United States government. When you buy US Treasury bonds, you are lending money to the federal government. The government pays you interest. On time. Historically, very reliably. This is why treasuries are called risk-free assets in finance. Not because nothing can go wrong, but because nothing else has been more dependable for longer. Banks buy them. Pension funds buy them. Mutual funds buy them. Insurance companies buy them. Why? Because when you're managing billions of dollars meant to pay retirees for the next 40 years, excitement is a bug, not a feature. You don't want to the moon. You want boring. You want predictable. You want something that doesn't vanish during a bad quarter. That's US debt. Now here's where it gets even more ironic. Some of the biggest buyers of US government debt are other parts of the US government. Social Security, Medicare trust funds, federal retirement programs. They collect more money than they immediately need, and they invest the surplus in treasuries. So the government owes money to itself, pays interest to itself, and then uses that money to pay benefits to citizens. Is it weird? Yes. Is it illegal? No. Is it how the system was designed? Also yes. About 1/5 of US debt works this way. Now let's talk about the group everyone loves to blame. Foreign lenders. Yes, foreign countries do own US debt. No, that does not mean America is owned by them. Here's how this actually works. Foreign governments, central banks, and institutions buy US treasuries for one main reason. Stability. If you're a country running a trade surplus, you end up with lots of US dollars. You need somewhere safe to park them. US treasuries are deep, liquid, and globally trusted. You can buy or sell them quickly without crashing the market. China, Japan, the UK, and others hold US debt not as a weapon, but as a savings account. Japan, for example, holds a massive amount of US treasuries. Is Japan plotting America's downfall? Number. Japan needs stable assets to back its own financial system. Dumping US debt would hurt Japan almost as much as it would hurt the US. This is mutual dependence, not domination. Think of it less like a hostage situation and more like two people carrying a very expensive couch together. If one drops it, both get crushed. Now here's the thing most headlines don't tell you. Foreign ownership of US debt has actually declined as a percentage of total debt over time. Americans own more of their own debt than ever. So when someone says, China owns us, what they usually mean is, I haven't looked at the data, but I'm very confident anyway. Now comes the question that makes economists sigh deeply. What if no one wants to buy US debt anymore? This is the nightmare scenario. If investors suddenly decided US treasuries were unsafe, interest rates would spike. Borrowing would become expensive. The government would have to cut spending or raise taxes aggressively. But here's the catch. Where exactly would investors go instead? There is no alternative market with the same size, liquidity, and trust. Europe, fragmented. China, capital controls. Crypto. Please, The dollar-based system isn't perfect, but it's dominant because nothing else can replace it at scale. That's the real reason U.S. debt works. Global demand. Now let's shift gears slightly, because this part matters for you personally. National debt isn't just a macroeconomic abstraction. It shapes interest rates, it influences inflation, it affects your mortgage, your investments, and your retirement. When the government borrows heavily, it competes with private borrowers. That can push interest rates up. When the Federal Reserve steps in to manage inflation, it changes borrowing costs across the economy. This is why understanding debt isn't academic, it's practical. Now let's address the question that sounds simple, but isn't. How much debt is too much? If you're hoping for a clean number, you're going to be disappointed. Economists often use debt to GDP ratios as a rough guide. Think of it like income versus credit card balance. If a country earns $100 billion a year and owes $60 billion, that's manageable. If it earns $100 billion and owes $300 billion, now we're talking. Historically, many economists considered 60% debt to GDP a safe level. The US is well above that. Japan is way above that. And yet both continue functioning. Why? Because debt sustainability isn't just about the size of the debt. It's about growth. It's about interest rates. It's about confidence. If your economy grows faster than your debt, the burden shrinks over time. If interest rates are low, servicing debt is easier. If investors trust you, they'll keep lending. This is why countries with much smaller debts can collapse while heavily indebted countries survive. Trust beats math. Which brings us to the most dangerous moment for any nation. The moment investors stop believing. When trust breaks, debt becomes explosive. Interest rates spike, currencies weaken, capital flees. This is how debt crises actually happen. Not overnight, not because of one bad year, but because confidence erodes slowly, and then all at once. Sri Lanka didn't collapse because it had debt. It collapsed because it couldn't service it, and lenders stopped trusting repayment. Argentina's repeated crises weren't accidents. They were credibility failures. Now let's confront a myth that refuses to die. Why don't we just eliminate all government debt? It sounds nice. Clean slate, no interest, no burden on future generations. Except that world is worse. Government debt isn't just borrowing. It's a cornerstone of modern finance. Treasuries are the backbone of pension funds. They stabilize insurance companies. They provide collateral for banks. Remove them, and the financial system becomes riskier, not safer. Without safe government bonds, retirement funds would be forced into riskier assets. Volatility would increase. Crashes would hit harder. Ordinary people would pay the price. Debt, used correctly, acts like shock absorbers. Those exist. Absolutely. Debt becomes a problem when it funds consumption without productivity. Borrowing to build bridges. Productive. Borrowing to paper over structural problems forever. Dangerous. The real debate isn't debt or no debt. It's what kind of debt and for what purpose. And this is where Americans need to be sharper. Because fear-based narratives distract from smarter questions. Not how big is the number, but what are we getting for it? Now let's talk psychology, because this matters. People fear debt because it feels immoral. Like living beyond your means. Like cheating the future. Like stealing from your kids. Politicians love this framing. It's emotionally powerful. It sounds responsible. It avoids nuance. But economies don't work on guilt. They work on incentives and systems. The real moral failure isn't borrowing. It's failing to invest wisely. And here's the part that should make you pause. The U.S. has carried debt for most of its modern history. After World War II, debt to GDP was over 100%. And what happened? The middle class exploded, infrastructure expanded, the economy boomed. Debt didn't destroy America. Growth absorbed it. That doesn't mean borrow endlessly. It means context matters. Now let's zoom out one last time. If you walk away from this video with only one insight, make it this. National debt is not a household credit card. It's not inherently evil. It's not inherently safe. It's a tool. And like any tool, it can build or destroy. Understanding that difference is what separates people who panic from people who prepare. Because the real risk isn't that the system collapses tomorrow. The real risk is misunderstanding how the system works and making bad personal decisions because of it. And we haven't even talked yet about the most uncomfortable question of all. Can a country ever truly be debt-free? And if it could, would that actually be a good thing? So let's finally ask the question that sounds smart at dinner parties and dangerous in real life. Can a country be completely debt-free? Technically, yes. Practically, almost never. And strategically, usually a terrible idea. This is where intuition betrays people. Debt-free sounds virtuous, pure, responsible, like eating kale and waking up at 5 a.m. But economies don't run on vibes. They run on incentives, trade-offs, and opportunity cost. A nation with zero debt is usually not a nation at the peak of innovation. It's either small, resource-rich, or quietly missing out on growth. Let's look at the closest example people love to bring up. Macau. Almost no government debt. Huge cash reserves, budget surpluses. Sounds amazing, right? Except Macau isn't a country. It's a tiny region, roughly the size of Manhattan, with under 1 million people. And one of the most extreme gambling-based economies on Earth. It generates massive revenue from casinos. It doesn't need to fund a global military. It doesn't need to stabilize world markets. It doesn't issue a reserve currency. You cannot scale Macau to the United States. And here's the key insight most people miss. Government debt is not just borrowing. It's infrastructure for capitalism. U.S. treasuries aren't a side effect of the system. They are the system. They are the foundation upon which pension funds stand. Insurance companies operate. Banks manage risk. Global trade settles accounts. Remove treasuries and you don't get a cleaner economy. You get chaos. Think about your retirement. Most pension funds are required to hold safe assets. That usually means government bonds. If those bonds disappeared, funds would be forced into riskier investments. More volatility. More crashes. More retirees discovering that the market does not care about their age. Debt, when managed, is a stabilizer. Now let's confront the uncomfortable emotional layer. Why does national debt feel so wrong? Because humans are wired for personal finance, not macroeconomics. You learned money as a moral lesson. Save, don't overspend, pay what you owe. Those rules work for individuals. They break down at scale. A government that never borrows is like a business that never invests. It might survive. It will not lead. And this is where the U.S. story becomes unique. America doesn't just borrow money. It exports trust. The dollar is the world's reserve currency. U.S. debt is global collateral. Treasuries are the reference point for risk-free. That gives the U.S. enormous power and enormous responsibility. You cannot run that system like a household budget, which leads us to the real danger. The danger isn't that the U.S. has debt. The danger is complacency. Debt becomes a problem when it's used to delay hard decisions forever. When growth slows but borrowing accelerates. When interest costs crowd out everything else. And yes, interest matters. As rates rise, servicing debt becomes more expensive. Money that could fund infrastructure, research, or tax relief gets diverted to interest payments. That's not a crisis, but it is a warning light. Now let's talk about you, because at this point, smart viewers start asking a more personal question. What does this mean for my money? Here's the uncomfortable answer. If you don't understand how government debt works, you will misread signals. You will panic at headlines. You will make emotional financial decisions. You'll sell when you shouldn't. You'll hoard cash when inflation eats it. You'll chase safety that isn't actually safe. Understanding debt helps you think long-term. It helps you separate noise from signal, politics from economics, fear from strategy. And here's a truth Wall Street rarely says out loud. Markets don't crash because of debt numbers. They crash because of expectations. When expectations change, prices move. When trust breaks, capital flees. That's why psychology matters more than spreadsheets. Now let's zoom out one final time. National debt isn't a villain, it isn't a hero, it's a mirror. It reflects how a society thinks about the future, risk, collective responsibility. The US didn't become wealthy by avoiding debt. It became wealthy by using it aggressively, sometimes wisely, sometimes recklessly. The question for the next generation isn't, can we eliminate debt? It's, can we use it better? And this is where I'm going to challenge you, not as a viewer, but as a thinking adult. If this video made you uncomfortable, good. That means you're paying attention. If it challenged something you believed, even better. Because the most dangerous thing in finance isn't ignorance. It's false certainty. Now here's the psychological pivot. You could close this video and go back to scrolling. You could forget this by tomorrow, or you could treat this as a moment where you stop reacting emotionally to money. A moment where you start asking better questions. A moment where you decide to actually understand the system you live inside. That's what this channel is about. No hype, no fear porn, no get-rich-quick nonsense. Just honest thinking about money, power, and reality. If you found value here, don't just hit subscribe out of habit. Subscribe because you want fewer lies in your financial thinking. Hit like, not for the algorithm, but because it tells us this kind of content matters. And here's the most important part. Send this video to one person, one friend, one family member, one person you actually respect. Someone you'd want to have a real conversation with about money. Not flexing, not arguing, thinking. And if you leave a comment, don't write "great video." Write one insight that changed how you see money. One question you're still wrestling with. One disagreement you want to explore. Because this isn't content for passive viewers, it's for people who want to think clearly in a noisy world. Thanks for watching. Welcome to the smarter side of finance.